Hello and welcome back to Bhavani JIB. Today we are talking about retail banking, specially made for Indian bank employees aiming to crack JIB. Today we are going to explore retail banking basics together. In our journey through paper 4 module A, we start with the fourth unit, branch profitability. Here we are going to learn about profit and profitability, measures of profitability, return on asset and return on equity, factors affecting profitability of banks, steps to improve branch profitability, and essential factors to make continuous improvement in profitability. Before we learn about profitability, we learn a little bit of the history of this chapter. How did banking system start? First, we need to learn about Banking Regulation Act 1949. Okay, remember that Banking Regulation Act was enacted in the year 1949 by RBI. Okay, this you need to remember. So, what does this do? This has provided the framework for the supervision of banks in the country. Okay, so in the development of the banking sector can be divided into three. Okay, so the first is the early phase, the nationalization phase, and the reforms phase. So, first is the early phase. They were prior to independence, that is somewhere between 1170 to 1969, I can say. There were close to 600 banks. During British rule, the three presidential banks of India were merged to form the Imperial Bank of India. Next is the nationalization phase. The Imperial Bank of India was nationalized in 1955, and in 1969, 14 banks were nationalized. Next is the liberalization or the banking sector reforms phase, we can say. So government set up the Narasimhan Committee, which we'll be learning later in the next chapters. So in the Narasimhan Committee, what happened? They gave licenses to open private sector banks. Until then, they didn't have any license in India to open any private sector banks. There were only public sector banks, that is the nationalized banks which we have. Okay, so far we are clear that this was the history of the banking. So Indian banking as a system has 12 public sector banks, 21 private sector banks, 45 foreign banks, and 53 scheduled urban cooperative banks. And to add to this, there is 1,470 unscheduled urban cooperative banks also. But for our consideration, we're just looking at the public, private, foreign, and urban cooperative banks. So, though the Indian banks are resilient, so what do you mean by resilient? They resilient means they're very strong and they can recover very fast. But despite that, the gross NP of the banks has reached 8.34 trillion. Just imagine how big it is. The quality of assets remains a matter of concern now. Okay, so why did this happen? See, there were delinquent advances meaning given to the wrong people. Okay, the money was put into the wrong people's hands, like for example the kingfishers. Okay, the banks have funded kingfishers, and even the PNB, for example, had given the letter of undertaking in 2018 to Nirav Modi. So all these things are like huge, they're huge amounts actually, which were given out and they all turned bad. So this has led to the, I'm not saying just that led to NPA, but I'm just giving you the examples of some of the major players. Okay. So this is the, they're trying to say that there is a huge NPA on the banks right as of now. Okay, so next we'll be learning. So what is called as the profitability and profit. So through the images, you can make out that one is very happy and the other one is very sad. Okay. So let's see why. So what is profitability then? So it is the measurement of efficiency. It means how efficient your organization is in making profits. More profit shows more efficiency. Okay. So, and less profit shows less efficient organization. So, this is about profitability. So, then what is profit? See, profit, it is the money a business makes. It is literally the amount of income. Okay. It is the money a business makes, taking out all the expenses. So, whether it is a small pawn shop or a multinational company. So, all this works on how much money you're making after removing the expenses. Okay. So, we'll see the difference between profitability and profit a bit later, but this is about profitability and profit. Okay. So, now we'll be learning something very interesting. Okay. There's some formula that you need to learn here. The gross profit. This maybe some people might already be knowing, people coming from the commerce background and all, but I'm just trying to explain in basic to those who are not from the commerce background. So, gross profit is equal to total sales minus the cost of goods sold. So, what do you mean by this? See, what is a gross profit? Total sales. Okay. That is whatever you have sold, right? I mean, the total amount of sales. This is easily understood. But what do you mean by cost of goods sold? The sum of all the direct costs associated with making a product, which includes um, money mainly spent on raw materials and labor. So you need raw materials to make any to manufacture anything, right? And then you need labor to manufacture that. So these two includes the cost of goods sold. This is called as the direct cost. Okay, it doesn't include indirect costs like what you incur in what this office expenses, salaries, administrative salaries, or marketing costs. So it doesn't include that. So this is about gross profit. And then what is a gross profit margin? So we will now talk about one example. Okay, this example will be carried off until almost the end of the chapter. So you please remember this. Suppose you have a orange stand. Okay, you are selling orange juice. Can you imagine like this? So you sell orange juice to people, and let's say you make 100 rupees. Okay, so cost of making orange juice. You had to buy the orange sugar and cups. There are many things, no, that you need to serve the orange juice. To make oranges, you need oranges, you need sugar, and to serve it, you need the cups. So all these things. Okay, so you are investing all that. So you have spent nearly 60 rupees on that. Okay. So what is the money left after you are subtracting this? See, this is the you are making 100 rupees and then you are spending 60 rupees on all these raw materials and whatever in labor, whatever. And the money left is what? After you subtract the cost of making the orange juice is what is the money left? 40. Simple, 100 minus 60, correct? So here, gross profit margin. So this 40 is your gross profit. Okay. So this is what we were trying to tell you. But the gross profit margin is like a percentage that shows how much of your sales money is your profit. So which means if the gross profit margin is here in this case, it is 40%. It means that every rupee you made, 40 is your profit. Okay. So that is the meaning of this margin. Margin for every 100, what is that you have earned? So this is the gross profit margin. I hope you understood so much. So the same thing applies for everything. Whenever I am saying margin, it means that for every rupee, how much have you earned? So that is the meaning of this thing. Okay, but this is the meaning of this thing. For example, for 100 rupees, you made 40. For 1 rupee, it will be 40 paisa. So it is like that. Okay, so this is the margin. This is the concept of margin. So next is the operating profit. What is an operating profit? See, it is gross profit minus operating expenses. So what do you mean by operating expenses? These are the costs directly tied to running the core business, such as employee wages. You are giving rent for that particular place, and the other day-to-day expenses will be there. So all this, if you're subtracting from the gross profit, you are able to get the operating profit. Okay, the same thing stands with this operating profit margin. That operating profit is for every a rupee that you have made, the sales that you have made, what is your profits? That is the calculation here. Okay, same thing holds good for this margin, operating profit margin. Just that we are calculating operating profit margin. There we calculated gross profit margin. Similarly, we will be talking about the net profit. Net profit is the operating profit minus taxes and interest. Okay. So here, suppose in the same example of this orange juice stand, okay, the government might, this is just an example, the government might want a share of your earnings in taxes. For example, you have to give the government, like suppose say 10 rupees in taxes. So this tax or the interest, suppose if you have taken a loan to start your orange juice stand, you have to also pay the interest for that loan. Okay, that and also the taxes that are compulsorily paid to the government. So if you subtract that from the operating profit, you will be getting the net profit. So, in other words, what I can say is net profit is what is left in your pocket after you have paid for everything you needed to run your business and you have settled your dues with the government. Okay, so after all this, whatever is left in your pocket is a net profit. So if it is consistently positive, it's generally a good sign for the business. So if the net profit is good, then your business is good. So that is the meaning of that. So same thing holds with the net profit margin, that for every sale that you're making, what is your profit? So that is the meaning of this net profit margin. It is net profit by sales. Everything is income is compared with the sales here, if you can see. Okay. So this is about the gross profit. Okay, gross profit margin, operating profit margin. Instead of you learning this like a formula, you have to try to understand through what example I gave you, this orange juice stand example. Through that, if you're able to learn, you'll be able to better understand this. Okay. So next, we'll be learning about what is called as the difference between profit and profitability. Okay, profit and profitability. Although the two terms are used interchangeably, profit and profitability are not the same. Okay, they are not the same. Profit is an absolute number which is calculated as total revenue minus total expenses and appears on the income statement. So what do you mean by income statement? Okay, this we will be learning elaborately in the accounting chapters. Okay, you need not break your head. You just remember that this profit, it comes under the income statement. This much is enough as of now. Irrespective of the size or scope of the business, a company's objective is to make a profit. Correct. The main objective, why did you start a business? You want to make profit. You're not making any charity. You want to make profit. Suppose in the same example of the orange juice stand, okay, you make rupees 100 in sales and you spend 10 on the lemon sugar cups I told you, and your profit is 40. Okay, we made this calculation, right? 100 minus 60 was 40. Okay, that is the profit. Then what is a profitability? Profitability is a measurement of efficiency. So it is a measurement, it is not an absolute number, it is a measurement. And ultimately, it's success or failure. You are determining its success or failure. It is used to determine the scope of a company's profit in relation to the size of the business. Suppose, say, same example of the orange juice stand. If your orange juice stand consistently makes 40 in profit for every 100 rupees in sales, it is considered to have good profitability. Okay, so every time in relation to the size of the business, you are making that profit consistently. Okay, it's not like you make 40 one day and then you make you don't make any money on the next day. So it is a consistent increase in the profit. So that is called as the profitability. And next we will be learning about profit and profitability in the context of banks. In banking, what is profit and profitability? So far we just learned it in general terms. So but what is it in banking? So we need to learn about the assets and the liability side. So this is the asset and the liability side. So here the major portion of a bank's profit comes from the interest that it earns on its assets and its service charges. See, for example, in banking, what do you mean by assets? Assets is the loans and advances that you have given. So asset means for bank, loans are the assets because they are getting interest from it, correct? So here the loans and advances given to individuals, businesses, and even the securities that it holds. Through that also it will be getting some interest. So, and what about liability? See, liability is what the deposits that the customers have with us. Okay, so for which you are paying the interest, which means you are liable. It's a liability for us. The deposits are the liabilities for us, and also it borrows from other banks. Yeah, I mean, if you really go in depth in banking, what happens is actually there are banks keep borrowing money from each other. Okay, so this is a concept. So here also this is also a liability, and also you are selling the commercial papers in the money market. See, all these things you'll be learning in the very in detail in the coming chapters. Okay, so they'll be selling the commercial papers in the money market and getting the money. So all these things are liabilities. So the bank is paying for all these things, and here bank is getting the money for all these things. Okay, so this is about the profit and profitability in the context of banks. So this is what we need to learn. Okay, so here in this we are learning about something called as the return on asset. Okay, return on asset. So before this return on asset, I want to talk about something called as the leverage or gearing. Okay, leverage or gearing, which we'll be again talking with respect to return on equity. But before that, I just want to give you a little hint of what a leverage is. Okay, so leverage or gearing is the extent to which the banks fund its asset with borrowings rather than equity. So, which means, see, I will give you an example. Suppose you have 100 rupees. Okay, you have 100 rupees, and you have decided that you will use your own money to invest. Okay, so if your investment gains 10%, okay, your investment is gaining 10%, then how much money are you making? 10% of 100, how much it is? It is 10 rupees. Correct? No, it will be 10 rupees. Okay, so you are investing how much? 100, and you have gained 10%, which means 10 rupees. Okay, 10% of 100 is 10 rupees. So you have gained 10 rupees. Okay, suppose this is one scenario. Suppose instead of using only your 100 rupees, you are also borrowing money from a bank. Suppose say. So how much are you having? You have your 100. You are borrowing money from some bank. Okay, which becomes 200. Correct? You have 200 now with you. Your 100 rupees and the 100 rupees that you have borrowed from the bank. So now you have 200, and now you have gained in suppose you have gained 10%. Same thing, same scenario. You have gained 10%. Okay. So how much is 10% of 200? It will be 20 rupees. Okay. Did you see the difference? So here it was your money. You had 100 rupees and you have gained 10%. You have earned a profit of 10%, and which means you have got 10 rupees. But here you have borrowed money, that is 100 rupees from a bank, and you have your own 100, so that is total of 200. So which means if you have a 10% profit, which means you are getting 20 rupees and not 10 rupees. So here what is happening? You may double the profit. you may double the profit. So by using both your money and the borrowed money. So this is the potential benefit of a leverage. So this is the potential benefit of a leverage, which means it also increases the risk. You need to remember this. Suppose if here you have borrowed money from bank, no? So you have earned a profit, okay, which is very good. Okay, but what if you have incurred a loss? Okay, you have also lost the money that you have put, and also you have to pay the money back to the borrower, okay, to the bank. So this might also have its own risks. So this you need to understand. So this leverage, again, we'll be talking later in the chapter. So please remember what is leverage. Okay. So leverage is the extent to which the banks fund its asset with borrowings rather than equity. So this line we will learn about it later in the chapter. Okay. So here, okay, let's talk about what is called as the return on asset. Okay, return on asset. These are the traditional measures of profitability. There are two measures. One is return on asset and return on equity. So the first one is return on asset, which is determined by the amount of income that it earns on its net interest income and fees on its services. So this line, you don't get scared by just looking at this line. I'll be explaining in detail what it means. Okay. So to here we have this assets and the liabilities side. You have to remember this thing. So what can you see other than assets and liabilities? Is something called capital, which is coming here. So capital means what? Capital means our own fund. No, like the our own fund. It means, okay, the owner's equity, or otherwise you can call. So okay, anyway, this you can just remember this. I will come to this later. So to give loans and to buy securities, banks must have money. Okay, you should first have money to give it to someone. No, first of all, you should have money to give it to somebody. Without you having the money, how can you give it to someone? This is a basic logic. So you'll have to beg, borrow, or steal the money. No. Okay, I'm just joking. For banks, okay, it primarily comes from banks owners. Okay, in the form of bank capital. It is coming from the owner or from the depositors. Okay, we just now we spoke now, and liability said we have the depositors, or you are borrowing money from other banks. Okay, so this is the thing on the right side here. Okay, so assets is equal to liabilities plus the capital. Capital means owner's equity. Just now we said the owner's money, or it could be the depositor's money. So all these things put together. So you see, here there's a sentence. Golden words are written here. All assets can't be used to earn income. So why? Please make note of every point I'll be telling now. Okay. All assets can't be used to earn income because banks have to maintain cash to give to the customers. Okay. They have to maintain cash. Okay. First one is cash. Okay. Cash. Okay. And they have to keep funds with RBI in the form of CRR and SLR. Okay, this again we'll be learning. Cash reserve ratio and statutory liquidity ratios might have already learnt about it, but you have to keep the funds with the RBI in the form of CRR and SLR. Okay. Next is they should also keep a separate account, that is a loan loss reserves, to cover possible losses during non-repayment of loans. So this is something called as a like to cover you, basically to cover the bank. They are keeping some separate accounts, which is called as the loan loss reserves. Okay, so this again you will be learning later. So what we need to know, understand here is we cannot use all the assets, the money here, to give away the loans. Okay, we need to keep some money with the banks for different uses. Maybe you have to give it in the form of cash to the customers, or you have to keep it with the RBI as in the form of CRR and SLR. So likewise, there are many uses here. Okay, so therefore, what we need to understand is here we have some We have to keep some money is what we understood here, right? So next we'll just try to understand that return on asset is determined by the amount of income that it earns on its net interest income and fees on its services. So now again, we'll go back to the example of the orange juice stand. Okay. For every rupee worth of the stuff you own, that is your assets, how much profit are you making? That is the concept of the return on asset. It means for every rupee that worth of the stuff you own, that is your asset, right? One is your asset. So on every 1 rupee of your asset, how much profit are you making on this? Suppose in the orange juice stand story, what is happening? Suppose say the total asset of that orange juice stand is 500. Okay. 500 is the total asset. That is for the stand, for everything. So the total asset of that orange juice stand is 500. And you are making 550 as the profit. Okay. You are making 50 as the profit. What is your return on asset? This is your asset. Okay. This is your asset. This 500. And this 50 is the profit. Okay. So what is the return on asset? Which means 50 by 500 into 100, because we are talking in terms of percentage. 50 by 500 into 100 will be how much? It will be 10%. Okay. It will be 10%. That will be your return on asset. Okay. So in simple terms, what can I say is return on asset helps you to see how well a company is turning its asset into profit. Asset into profit. So here in this case, 10% of the asset has been 10% of the asset is the profit here. So that is a return on asset here. Okay. So let's go with the traditional formulas that they've said, but this is the actual concept that you need to understand. So net interest income is nothing but interest received on assets and interest paid on liabilities. So as I already told you, on assets, that is on loans, we receive the interest, and in the case of liabilities, that is deposits, we are paying the interest. So the subtraction of these two will be the net interest income. Next is the return on asset is equal to fee income plus net interest income minus operating costs. So what do you mean by fee income? See, other than this income that we get through loans, we also have some fees now. That we have the service commissions, and we have different fees that we collect. So this fee income plus the net interest income minus the operating cost, which means what you are spending on the operating cost, like suppose salaries, everything, wages, everything. So this divided by the average total assets. As I had told you, so here profit, we are calculating the profit by the asset, right? 50 by 500, I told you. Same thing they are trying to tell you, but it's more elaborate. That's it. So here, this is the total net income. This is the net income by the total assets. So that will give you the return on asset. Okay, so this is the whole concept of return on asset. Okay, I hope you understood this. So in total, we understand that return on asset helps you to see how well a company is turning its asset into profit. So asset into profit. You have to remember this sentence. Okay. So next is something called as the return on equity. So equity means shareholding. So you remember this as of now. Okay. So this we need to like learn these points before we learn what is the formula on return on equity. So owner's equity formula. What is owner's equity formula? It is equal to assets minus liability. Okay. So what is happening here? Okay. What happened here actually? Asset was equal to liabilities plus capital in this. So here what is happening? The capital is equal to assets minus liability. Okay, very simple it is to understand. So when you look at the formula, you can put each one on the other side, and you will understand what it is. So here the owner's equity or the capital is equal to assets minus liabilities. This much you understand as of now. So here what happens is, to purchase more assets, banks need to pay for it either with more liabilities or with bank capital. So if you want more assets, you need to pay for it, right? Or else what will you do for it? Either with more liabilities or with bank capital. So either of this, how are you giving the money? Asset means you need to have some money to give it as loans, no? So for that, you need to either get it through deposits or from your own bank capital, you should be able to give. So that is the first point. Second point is, to earn more profit, owners would use liabilities rather than their own capital. Okay. Why? Instead of using your own money, it's better to use others' money. That is what it means. Okay. So here, to earn profit, the owners usually use what they are getting from other person, not from their own money. Because this is the business strategy. Because the next point is, therefore, increasing the number of loans compared to the bank capital will generate profits to the bank. So by increasing the number of loans compared to the bank capital, you're not taking out the bank capital, you are just increasing the number of loans. By doing that, what will happen? You will be generating profits to the bank as well. So this is the whole concept, and you have to learn that to earn more profit, owners would use their liabilities rather than their own capital. They will not use their capital, they will use the liabilities instead. Okay. So next is leverage ratio. We're coming back to leverage. Leverage. What did we say? Leverage ratio. Okay, leverage or gearing is the extent to which the banks fund its assets with borrowings rather than the equity. Okay. So you go back to that leverage ratio, you'll be better able to understand this. But as of now, I'll be telling you what it means here. Okay. So leverage ratio is equal to bank assets by bank capital. Okay. So what is a return on equity then? Return on equity is return on asset into leverage ratio. So what we learned, return on asset, no? So what returns did you get? What profit did you make on asset into the leverage ratio will give you return on equity. So in other words, what is return on asset? We just now learned the return on asset is the net income by the bank asset. So like, what income did you make on the bank asset? So that is the formula, right? Then what is leverage ratio? Bank asset by bank capital. Okay. So when this, like the bank assets and bank assets get cancelled, what are we left with? Net income by bank capital is the return on equity. So what happens? Return on equity will become the net income by the bank capital. Okay. But there is one more concept that you need to learn here. Okay. So what is it? What is the concept here? More on the leverage ratio. For example, the bank assets is 100. Okay. Imagine bank asset is 100 and bank liability is 95 and the bank capital is 5. Okay. Let me just erase this. So what happens is, bank asset is 100 and bank liability is 95. So the bank capital is 5. Let's imagine these figures. So what happens in the leverage ratio? What happens in a leverage ratio? What did we say is a leverage ratio? It is bank asset by bank capital, which is 100 by 5. Okay, 100 by 5. What is 100 by 5? It is 20. Okay. So what happens? The leverage ratio is 20. So if the value of its assets, this is just an example they're trying to tell you, that if the value of these assets, okay, drops by 5%, drops by 5% means what happens to this bank assets? It becomes 95. Okay. So what happens to the leverage ratio then? Leverage ratio, no, we cannot calculate because 95 and 95, we cannot see here. What happens is, when if the value of the assets drops by just 5%, then the bank's capital will be wiped out, right? 90, see, 100 minus 95 is 5. That is a capital. But if this becomes 95, 95 minus 95, there's no capital. It becomes zero. It becomes zero, right? So the bank capital is getting wiped out. This should never be the scenario. So typically, the leverage ratio should be around 10 to 12 for banks. So you remember this, should be between 10 to 12. That is, if the bank's assets should be at least 10 times the value of its capital, but not more than that. But not more than that. Okay, it should be just 10 times or 12 times the value of its capital, but not more than that. Because higher leverage ratio means that the bank is more reliant on the borrowed money and not its own fund. So this might, if something happens, something goes wrong, neither do you have the money and you are completely dependent on the money borrowed. So that is not the correct scenario. You should not be completely dependent on the borrowed money. You should also have your own money there. Okay, so that is the concept of any business, and in particular, because we are talking about banks, this is the concept. Okay, so this is about return on asset, return on equity, and the leverage ratios. These are the three main things that we'll be learning in this chapter. Okay, so the next one is what is called as the strategies. Okay, strategies of for improving the bank's efficiency. The first one is the business realignment. So realignment means what? To exit from the business lines that have low margins, okay, low profits. If it has low profit, just exit from that business line and move instead to the lines that are cost effective and increase the bank profitability. Because this is one of the strategies. The second one is channel optimization. So what do you mean by channel optimization? To access the various ways customer interacts with a bank in order to be cost effective. So you should channelize that particular thing. For example, virtual account opening, okay, cardless cash. These are some of the perks you're giving to the customer. Okay, and you're channelizing the usage of the accounts to the customer. Next one is process cost. It takes more of a manufacturing view. Okay, the main goal is to reduce the unit cost of each activity, like account opening, doing any transaction. So you're reducing the cost on each activity. For example, instead of you just keeping a cashier and just doing the transactions, like you just giving the money and taking the money, instead you can have an ATM or a bunch note acceptor or a cash deposit machine which can do the job, right? You have to reduce the cost on that particular activity. Okay, so and also account opening, you can make it now. I think we have the centralized processing hubs and all that where they're opening the accounts instead of opening the accounts at the branch levels. Okay, so this is the process cost. Next is the technology and automation. To allow customers to make transactions on a self-service basis. Okay, so they should be able to do their own transaction. You're automating them. Okay, to use technology to reduce the time employees spend on finding the information. So instead, the customer himself should be equipped to do these kind of transactions on his own. Next is the sophisticated customer segmentations. So we need to observe the customer's tenure with the bank. That is, how many years is he banking with us? Frequency of interaction, channel preferences. What is his lifestyle? What is his loyalty to the branch? Price sensitivity. All these things we need to keep a view on this, and that is when we will understand what are the needs of these customers. Okay, so this is the customer segmentation. Next is the digital revolution and big data. Engaging customers through social media and creating a digital service platform. A big data is the new technology which is able to anticipate customer needs and resolve them before they become problems. Okay, this leads to increased sales and customer satisfaction. So this is the upcoming field here. So these are the strategies. There are many more, but we have just focused on some six strategies to improve the bank's efficiency. Next is the steps to improve branch profitability. How can you increase the branch profitability? So you need to focus on balancing profit, growth, and risk. Branches need to balance these three principles: profit, growth, and risk to maximize the performance and build sustainable earnings. Next is assess the strategic fit and unique role for each branch instead of setting common goals to all branches. See, based on where your branch is located, and many more things, who is there in the branch, who is working. So based on all these things, you can you can assign a unique role to that particular branch instead of just giving common goals to all the branches. So the next one is you analyzing the competitor or the competition, understanding the strength and weakness of the competitor, that is the competing banks, or like private sector, or in public sector only you have the other banks. So you're just analyzing what are the competitors doing. So this is also a strategy, right? Next is the customer approach. See, analyzing the customer base for each brand. So what kind of customers are there? So what are their needs? So all these things have to be checked in order for you to increase the profitability. Okay, so the other steps to improve profitability include focusing on NPA. Okay, giving more quality loans which will not go default. Okay, focusing on non-interest income, low cost deposits, holding minimum cash, cost management, good customer relationship. All these things will lead to profitability of any branch. Okay, so I think we are clear with this. So, next, see, to summarize, what have we learned so far? Profit and profitability, measures of profitability, return on asset and return on equity, factors affecting profitability of banks. So here we also learned about leverage, okay, and steps to improve the branch profitability and essential factors to make continuous improvement in profitability. Okay, so these are the things that we have learned. Okay, so don't forget to subscribe for more insights into the world of banking. Stay tuned, stay informed, and keep banking the Bhavani JAIIB way. Thank you. And next up, we'll be learning the first unit of Module B. Until next time, happy banking.